You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again. It is Wednesday. Education Wednesday, as it is known around these parts. Time once again to roll out the old OBC. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which all of you folks are binging these days. If you missed the big vol death match from last week, I encourage you, check it out. Head on over to the pro, theoptionsinsider.com/pro. Of course, it's not just about the death match. That was just a fun cherry on top. Of course, yesterday, if you like vol, we had Scott Nations tackling all your vol questions. What's going on with the impact on vol from the current Middle East conflict? What's going on with SVIX and VXX and VIX and everything else under the planet? We talked a lot of vol on the Pro Q&A yesterday. Of course, options oddities at the end of every week, and a whole bunch of other fun live streams, giveaways, goodies, exclusives from conferences like the OIC and others. Head on over to the Pro. Theoptionsinsider.com/pro is the only place to get all of those goodies in one place and a whole bunch more. And of course, if you're listening live, you get to heckle none other than the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. Are you ready for some heckling, sir?
Let's do it. Let's do it.
All right. With the team assembled, let's dive on into a little bit of the old options drills.
All in boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, buddy, welcome to Options Drills, where we take some options techniques or terminology or some tips and tricks for how the pros get things done, and we explain them for you, how you can utilize them in your portfolios. And Dan, our chat's already having fun. They're just posting a bunch of heckle in the chat. So they are already officially heckling you. So prepare yourself, sir, for some vicious, dare I say it, vindictive heckling going on throughout the show. But Dan, we had so much fun last week on the Options Drills, exploring some terms that have been lost to the fog, the arcane, dark, impenetrable fog of the options market. And we discovered so many as we were doing the show that we thought, you know what, can't fit them all in one episode, Dan. So it's time for part 2 of forgotten, lost options terminology. Are you ready, sir?
Yeah, man, I'm ready. You know I'm ready.
All right, I will kick things off, and I know you have a bunch that have resonated to you want to add to the discussion as well. We'll kick it off with a boring one just to get things going, Dan, just to get the juices flowing. And this is the term that, I mean, unless you're deep in the weeds of options and futures, you may not even be familiar with this term. These are Section 1256 contracts, Dan. Again, not the sexiest of things, but an important term. If you're out there, let's say, for example, choosing between trading SPX or SPY, then this term is very important to you. What is it? Well, it's more colloquially known, listeners, as the 60-40 rule, and the contracts that benefit from it are called 60-40 contracts, which is why maybe this specific term, Section 1256 contracts, may be unknown to you. But if you're trading something like SPX, for example, listeners, which a lot of you are these days, then they qualify for special tax treatment. That 60-40 tax treatment that I referred to earlier. So 60% taxed as long-term gains and 40% only taxed as short-term gains, which is fantastic for SPX traders, especially given the fact, Dan, that, half of all SPX volume right now is 0-day. It's literally going up and closing in 24 hours. So it is by definition the most short-term paper, and yet 60% of it taxed at long-term capital gains. They snuck a good one in there with that, Mr. Dan. So yeah, there's a fun term. You may not know it, but an important one, especially if you're slinging a lot of 0-day SPX these days, Dan.
Yeah, it's pretty funny. I didn't really think about that. The shortest term trades get the 60-40.
Yeah, long-term tax treatment. Yeah, they snuck a good one in. People have, especially in the regulatory side, have explored revisiting that. I know a lot of the exchanges obviously don't want it because it's a big driver of paper for them. But it is an interesting thing. You're out there slinging 0-day SPX, Dan, and you're being taxed 60% like you held it for a year or longer. Not a bad do, as the kids say. So one of the reasons why some folks lean towards the SPX side of the equation versus SPY on that one. So again, an unheralded term. You may know it by other more colloquial terms like 60-40 or other things like that, but the actual origin of that exemption is Section 1256, hence Section 1256 contracts. All right, Mr. Dan, I kicked it off in the weeds with some minutia. What you got for us? What's a term that you think has been forgotten to the sands of time, sir?
This one, like, I would use all the time, several times a week, I think. And the concept still exists, but I don't think people actually use this term anymore. Print. So sometimes if I had like a situation where, I thought this traded at a certain price, or there was a trade through, or there's some problem with the trade, I would talk to the person that I made the trade with and say, no, look, it didn't even print $2.65, meaning that it never actually traded at that price. And it's kind of funny that we use the term print then, because I guess print comes from the idea that from like ticker tape, where it was actually printed on a piece of paper, but they weren't doing ticker tape, when I was trading. I'm not that old, right?
You're close.
Yeah,
you're the tail end of ticker tape, sir, but not quite.
Right. Yeah. So, hey, did it print at that price? Meaning, did it trade at that price? Which is, it's still relevant because all the prices that every option trades timestamped to the millisecond and everything, it's actually probably even more relevant now, because now one of the ways exchanges make their money is on selling data, and that data is prints. It traded at this price, and people pay for that information, and they pay a lot of money for that information just to see what traded at what price, when and where and by whom and all that.
Yes, that is the case. And it kind of goes back to what we were talking about last week, Dan, with the term paper. A lot of this originates from, the physical paper that a lot of these trades went up on. But yes, the notion of a ticker tape, I just find that hilarious. Sitting there waiting while the tape goes by, you got mountains of paper at your feet by the end of, what a way to trade, Dan. We missed the good old days of ticker tape.
Yeah.
All right. There's more to get to, listener. This is another one. Dan, you and I have used this term quite a few times on the show. But for a lot of our newer listeners, and certainly everyone whose origins are in the retail space, they may not have ever encountered this term. And even now that most market making firms have gone the way of the dodo, this term has kind of been lost to the sands of time as well. What are we talking about, listeners? The term delta neutral. This is the way I got into the business. I'm sure this is the way Dan got into the business. This is the way when you were a liquidity provider, a market maker, this was the way you were initially trained, which was, of course, to be delta neutral. As the term implies, listeners, it meant you didn't want any delta risk. You didn't want any directional risk in your portfolio, listeners. That's the one Greek, if you think about it, listeners, it's the one Greek that's really easy to hedge away. If you have directional risk, you can just sell shares of the underlying against it and wipe that out. So that's what we would do. Harder to wipe out vega risk, harder to wipe out gamma and theta. You're always going to have residual positions in those. But delta, you can. So if you're long 3,000 deltas of a particular underlying, bam, sell the stock. Now you're flat. You don't have to worry about that, at least. And so that was the way most of us were trained. Of course, fast forward to today, even most of the prop firms don't even go delta neutral. Look at that term I even used, prop firms. They're now prop traders, Dan. They are there to take proprietary risk in various names. So that's another way that the business has shifted. The notion of coming in and going home flat, at least from a delta perspective, is gone. You are now encouraged, Dan, to take those different risks, be they vega or delta or whatever you want to do at the end of the day. That's part of the deal now. So yeah, delta neutral, Dan, kind of lost to the fog, the sands of time, sir.
Yeah. Interesting. I mean, gosh, it's got to be so much harder to do that now. I mean, don't get me wrong, trading delta neutral in and of itself, I mean, it's not something where you always made money or anything. It had certainly had its challenges, but going and taking a position, I mean, that's a whole new skill set than the skill set that I was trading with back in the day.
Yeah, we had that beaten out of us. We would sometimes come in and say, hey, earnings are coming up. Maybe I want to be long a little vol here. I want to be long this. And they would always beat that out of you, saying, no, you can't have any net position. Sometimes sanity would prevail and they would allow you to have a lot of, let's say out of the money puts in your back pocket. That was just having bullets for a rainy day. That was sanity. You didn't want to be net short units, of course. But outside of that, having any sort of directional exposure, and even for me, Dan, in the early days of my migration out of the SPX and into some single name trading like Intel, listeners, I learned really quickly that you couldn't really take the delta neutral approach and the position neutral approach that you would have in the SPX, because even back then, the flow in big names like Intel was so one-sided that you just had to get ahead of it. So, I mean, paper every day was literally just dumping calls in your lap and buying puts. So the skew would get extreme very quickly. So second a new month was listed, Dan, every market maker was hitting every bid and every call ahead of everything they could, and they were buying every put they could out of the book or from each other or calling away, whatever they could do just to load up the bullets so that you would have some to trade when you were inevitably choking on calls and you had no more puts to sell. You needed some of those ahead of time. So even in those early days, you started to morph into a bit of a prop trader just by necessity, just by defense. You were still delta neutral, but you had other residual positions that you would lean on. And speaking of which, leaning on, Dan, that gets to one of your forgotten terms, leaning on something. What is that, Dan? Another term that has maybe been lost to the sands of time.
Yeah. Oh, but before we get to that, you reminded me of something else here.
All right, get to it.
The uptick rule.
Oh, yeah. Did you ever get caught looking for a box of upticks on the floor, Dan?
Yes. Oh my God, I lost my.
I never did that, but I saw a lot of poor clerks get put through the ringer on that and spend a very stressful day looking for a box of upticks all over the floor, and they never could find it, sir.
I know. I sent some clerks doing that.
Oh, you were that guy. I could see that.
Yeah, but what Mark was referencing, I think, is you would have to, like, if you're buying if you're buying calls or selling puts, you've got a short stock. And there was something called the uptick rule, where you were not allowed to short a stock unless the last tick in the stock was up from the previous tick. It was an uptick. So, like, if it's trading at 50 and it goes down to 49.99, you can't short it. You got to wait until it goes back up to 50. If it goes from 49.99 to 49.98 to 97 to 96, you just can't short it. You're just watching it go down and down and down, and it could be like really, really stressful. So yeah, uptick rule.
Yeah, it seems antiquated now, Dan. But when I was first coming out of college and I was looking at various things, and I was looking at some market making firms were recruiting me, but I was also getting recruited by some day trading firms, which were kind of shady. And I remember looking at what they were doing and not liking their operation. And their big selling point to me, Dan, was, if you come in here, we have technology that will let you sell stock without an uptick, huh? What about that? That's amazing. So that was that was my first inkling that maybe they were a little bit dubious. It seemed kind of, let's say, a little bit less than legal what they were up to. So I said, thanks. I think I'll try my luck at this Chicago market making thing. But yeah, that was my first sign. Now, of course, kind of antiquated. You don't need to wait for such things anymore, Dan. Yeah. But yeah, talking about another one, we were saying, I know this is one of the ones you wanted to get to as well, which is leaning on something. Another term that you don't really hear anymore. Came from a lot of the position trading and market making, where, let's say, for example, listeners, there was an order in the order book sitting there. Let's say an order to buy 100 of some calls, maybe slightly out of the money calls. If you saw that in the book, you could lean on that. But what I meant is that effectively you knew that was there. So now you could have a little bit more wiggle room to buy something else that maybe you wouldn't buy, because you could turn around and you knew you could sell these calls against it and leg into. Remember, he talked about legging on the last episode. Listen, you could leg into a spread at maybe a better level than you could otherwise. And so maybe you'd be a little bit more aggressive buying something than you would otherwise, because you had this order in the book you could lean on. So a broker comes in offering to sell some calls. You might be like, well, I don't know if I really like that level, but now I'm leaning on this other order in the book. So, I'll sell those, I'll buy yours, and I could leg into a spread at a better level than I otherwise could have. Dan, what are your thoughts and memories of leaning on various orders, sir?
Oh gosh, yeah. I mean, I would lean on stuff many, many times a day. I mean, including the stock price as well. Because if I've got to sell if I'm offering to sell these calls at 50 and the broker is 490 bid, well, that's based on where the stock is trading. Because as soon as I sell those calls, I've got to buy the stock. And so I would sit and I would watch and be like, okay, the call's got this delta, just say a 50 delta. So that means if the stock goes down 20 cents, my offer is going to go from 50 to 49.90. It's going to go down by a dime. So I would just sit and watch the stock. I would be basically leaning on the broker's order. And if the stock went down, I'd sell it to the broker, buy the stock, and boom. And I mean, we do that all day long, every day.
It was pretty much a fundamental part of the job. And I should say, retail can kind of still do this. If you're looking at an options chain and you see some weirdly tight market sometimes, you might dig in and see, this market, usually whatever name you're looking at, the options are maybe 100 by a couple of hundred. And this one's maybe really weirdly tight on the bid especially, and it's like 10 by 300. You can say, okay, someone's got a resting order in there. I can maybe lean on that 10 lot. And so now I could come in and turn around and do another, let's say, 10 lot against it somewhere. And if you get filled there, immediately turn around and try to hit that bid that's lurking in the order book. So you can still do that, even though maybe the terminology, Dan, kind of lost to the ether. I know you got some more, Dan. Hit us with another one, sir. This is fun.
Yeah. So, I mean, this one, I don't know, maybe people still use this, but you sure don't really hear retail people talk about this, but blow up like, oh yeah, Charlie. Yeah. He doesn't work here anymore. He blew up.
Yeah. Not blown up in a good way. Like he's really blown up on the charts right now, not like that. Different connotation now.
Yeah, like leaving a big hole in the ground and blow up. So, and some people will say blow out. Yeah. Oh, yeah. You know, Charlie, he blew out last week. Not going to see him anymore. I saw him working at the car wash the other day. So, yeah, if you blow up your account, that's not a good thing. That's not a good thing.
Yeah, this term was used a lot. I would often use it and see it with the guys who were, you know, the teeny put sellers back in the day. You know, the guys who would hang out and whenever they saw a bid for nonsense in the book or a broker came in with it, they're sold to you. And they were just picking up the literal 16ths of a dollar, listeners back then, ahead of the steamroller. And then inevitably something would happen and they would blow out. And I would always joke, you see these guys back again a few months later, different jacket, different firms. They could always con someone into backing them. So I guess that was their greatest skill at the end of the day, Dan. Not market making or selling teeny puts. It was conning someone else into giving them money to do the exact same thing that had just blown them out at another firm a few weeks before. So yeah, these guys, they were kind of like cockroaches. They would blow out and they would keep coming back, different jackets. It was a strange phenomenon to me even then. Speaking of trading floors, a lot of this terminology originated on the trading floor, Dan. This one was brought up to me last week, actually right after we did the show. I was doing the futures rundown with our buddy Carly Garner. And she mentioned this one to me, and I was like, oh, yeah, you know, that is another term you don't hear very often, Dan. And this was effectively off the floor. And what I mean by that, Dan, is you would always hear, this guy is an angel off the floor, right? He's on the board of 50 charities. He's adopted 100 orphans, and he's left all of his money to various good causes. He's a deacon at his church, and he's the best guy you ever want to meet. Off the floor. On the floor, he will literally stab you to death for a one lot of a trade somewhere. But off the floor, he is a living saint. How often did you hear that, Dan?
A bunch of times. And, you know, when I was thinking of this, I was thinking of a different context of this. But yes, that is absolutely a thing.
Were you thinking like OTC, like off the floor that way?
Well, being upstairs, I guess, upstairs trader. So like when we were trading on the trading floor, like, you know, we were the floor traders, and somebody who was a position trader, you know, like a professional, he's trades upstairs. Now, upstairs could have been in Miami or, you know, Arizona, but it just means not on the trading floor. Oh, he's an upstairs trader.
So I can't take credit for that one. That was Carly's suggestion. As she said that, I was like, oh, yeah. Literally every guy you heard that about, which kind of made you wonder if it was really true. You know, could all of these guys be living saints off of the floor and complete horrific bastards on the floor? Is it possible to have that degree of schizophrenia in your day-to-day life where the second you take off your trading jacket, you just go hug all your orphans at home, put that jacket back on, and you're just punching people in the face for one? I mean, the degree of that duality, Dan, I don't believe it could be that wise. But a lot of these guys, I think, were just jerks. Spoiler alert out there. Speaking of jerks or having fun or just heckling you from earlier, our chat said, going back to your ticker tape comment, Dan, they said they could see you with a monocle and watching some ticker tape, reading some ticker tape. So there you go, Dan. Maybe that'll be our, we'll have an AI generated image for this show, and it'll be Dan with a monocle and and a top hat, of course, reading some ticker tape over there with some lost ticker from, 100 years ago. I like that idea. Producers, take note. We'll give the AI a workout on this one, Dan. What do you say?
Nice.
All right. I've got that one, Dan. What's your next one for the folks?
Oh, gosh. I keep thinking of more. Oh, my gosh.
Might have to do a part 3 and a part 4 of this, Dan. I don't know.
I know. It's like making up our own language or recalling our own language. Okay, so hit the bid or lift the offer. So it's kind of antiquated now, and I think it was derived from necessity, derived from when a broker came into the pit and asked what your market was in a particular option. You wouldn't say, well, I would pay on the bid 37 cents, and I would, like, by then the trade's done. So you would have to just blurt out the words as fast as possible, and so everything was kind of shortened. You'd say 37 at 39. You just have to have the ad. Actually, sometimes you wouldn't even say that. 37.39. The bid was always the first thing. The offer was always the second thing. So because the bid was lower, you'd hit the bid, and the offer's higher, you would lift the offer. And I guess those are kind. I think of those as kind of related things. Just the 37. Well, and sometimes they would say 37 to 39, which I never kind of saw how that connection happened, but that was kind of the part of the nomenclature too.
Yeah. I mean, you still hear that every now and then, but you're right. It is lesser known, lesser heralded. That gets to like I'll save this maybe for a future show, another term it makes me think of as well. But there's another one, Dan, that I wanted to get to today that is very much a lost term. I think you and I have mentioned it once or twice on this show, just kind of being like how weird and antiquated this is. Even back in the day, Dan, when a broker would come in to quote this, it was a rare occurrence. You'd remember, you're like, oh, you want that? Okay. But what am I talking about, listeners? I'm talking about guts trades. So what's an example of a guts trade, listeners? And, the common example people refer to is, a typical strangle, listeners, which you'd get quoted all the time. Someone wants an out-of-the-money call and an out-of-the-money put for obvious reasons. They want to put on a position that either speculates on and profits on a big explosive move, or they don't think it's coming. They want to sell that. Either way, they want out-of-the-money options for that. It's just obvious. Now, the guts version of that is the opposite. They want an in-the-money call and an in-the-money put. And that is what's known as a guts strangle. And you can take that guts term and apply it to a lot of things. The guts really comes from, I believe, these old terms that have, insect, origins like butterfly and stuff. And the guts would be like the thorax, the middle part of that spread. So I'm pretty sure that's where it comes from. But I saw it often used with the gut strangle, but you could do, guts flies and all kinds of weird stuff. Damn, but it would always be with the opposite of the option you would expect, the meaty, the in-the-money one. And as you can see, the use case for it is kind of obtuse. I mean, who really wants an in-the-money call and in-the-money put strangle, right, Dan? Is that something you're looking to buy and spend a lot of money on?
Yeah, no, it's definitely kind of weird. But, I always thought of the guts as like a Chicago guys with the deep dish pizza, Chicago style hot dogs, like the guts is like the fat part, like, sure, you could sell a strangle, like, usually an out of the money put, out of the money call. But if you do the in the money put and the in the money call, it's synthetically the exact same thing, but it's just like, there's so much more weight to
more meat on the bone. Yeah.
Yeah.
Which again is an odd way to do it. You just really wanted to tie up a lot more capital to do that, right? And I was talking with our buddy, Mr. Dr. Vix, about some deep in the money VIX put trades last week on vol views. And we were all just scratching our head. You're talking like 80, 90 handles in the money. You're like, why would you do this? Why would you commit this much capital to get short VIX? There's other ways you could do it that are functionally equivalent that don't tie up $80, $90 a contract. So this is the same kind of thing. Like the use case for the guts was always, even back on the trading floor, we'd be like, are you sure you want this? You want the guts thing? You have to check because it was such a rare occurrence even then. Now, listeners, it is kind of completely lost to the mists, the fog, the sands of time. Dan, what else is resonating for you? What is, as you're shaking off the day drinking today, sir, what is occurring to you in terms of terms that have been lost forever, but not to you?
How about the Squawk Box?
I think the only reason people know this now is because of that little segment on CNBC, right? That's it.
Right.
They don't know what it means. They just see the segment.
Right. I remember when I first started as a clerk in like 1993, going up into one of the conference rooms in the office suite, and I walked in, we're sitting at the table for some meeting or something. And there's this like kind of like triangular shaped thing. And it's just like a flat thing laying on the ground. And it's got like a I don't know. I mean, in hindsight, I know what it is. The only way I can describe it is what it is. It's like a speaker, round speaker head on the top of it, and then there's like a couple buttons and a cord coming from it. And one day I was just like, "What is that?" Like, you know what that is? It's a Squawk Box. I'm like, "What the hell's a Squawk Box?" But then, even though I didn't know what it is, and this person was like, "You don't know what that is?" It's like, well, what they used to do with it. And they didn't even do it at the time, but because stuff is traded on different floors, like for example, like I think if you trade SPX, you might be hedging that with the futures over across the street at the different exchange, or the CME. And so someone would listen to somebody just reading, hey, here's what the bid is. 37 at 39, 37 at 39, 38 at 40, 38 at 40, 37, 39, 36, 38. And the person would just squawk into the thing and people could listen to it on the Squawk Box, which is just this dumb thing sitting on the desk. And now, I mean, you didn't really need it when I started in 1993, but you really don't need it now because I mean, nobody has to read it anymore. It's just electronic. It just comes in and now it's just programmed. You don't need somebody to tell you what to do so you can do this. Just automagic. When this happens, then this other thing happens because that's how it's programmed.
Yeah, I wonder if you polled CNBC viewers of that segment, what percentage would actually know what the hell the origins of the name of that segment are. Even some of the people on the show probably don't even know. Let's go. This is just a silly one I threw in here, Dan. It's not really forgotten because we do talk about it every now and then when we get to the expanded list of Greeks. But for a long time on the network, I would say the decade plus leading into and even kind of the early years of the pandemic, it was completely forgotten. What am I talking about? It's Rho, Dan, the redheaded stepchild of the Greeks, the forgotten. People only remember it in times like right now when rates are 7%. I used to joke on our network with your nemesis, Uncle Mike. I would say to him, we would know that rates are getting spicy again when people start asking us about Rho. That is the only time anybody gives a crap about Rho. And for a decade plus on the network, nobody gave a crap. This might as well have been a term from astrophysics as how much it was used here on the network and how much it was asked about. Now, last couple of years, rates hanging out. The notion of rate cuts is a thing again, and people are debating it all the time with the Fed. Now, Rho, back in your vernacular, listeners. But even still, for most of you out there, the 50% of you who are just living 0-day SPX, Rho will never be a thing for you. You will never have maybe today, if there's a dramatic, today's Fed day, Dan, and for listeners listening after the fact, maybe if the Fed does something wild, you might have some intraday Rho, but even then, that's a complete crapshoot nonsense thing. That's the only time you maybe even have to pay attention for Rho if you're slinging 0-day. Dan, what are your thoughts on Rho, Dan, the forgotten Greek?
Yeah, I mean, I talk about Greeks more than anybody else, I think, and I don't even talk about that one. And it's funny because it is in play now, but still nobody talks about it. They're just not used to talking about it. It's like it kind of is a forgotten term. It really kind of is, because people who trade, well, I guess maybe that's part of it too. I was going to say people who trade longer term options need it, but longer term options they're just not sexy these days. So yeah, pretty forgotten term.
Just not sexy. Don't even get me started on the second order Greeks, Dan. Completely lost. All right, Dan, what's another forgotten term you want to share with the folks?
Yeah, I thought about this one while we were talking. An ARB clerk.
Oh yeah, that one is that's an old one.
Probably you probably started as an ARB clerk at some point, right?
I did some of that for a while in the index. Yes, that's how you start in the index. You got to do the headset. You got to learn all the ARB, of course. You could ARB back and forth between the CME S&P pit and the SPX pit. Yes.
So ARB is the name of the hand signal language that was used on the trading floor. And what I mean, there still are trading floors. They're new. I don't know if I guess they do still use them, but not very much. Usually it's just verbal. But yeah, an ARB clerk he was basically somebody who would stand around the side of the pit. And this was especially true for the indexes where Mark traded for a long time. They would stand with a headset on and they would be listening to somebody at the other exchange quoting the futures price so that the SPX traders would know the futures price. And they, there's like hundreds of people there. They can't yell it to their guy across the floor while everybody else is doing it. So they would just use hand signals to show the price. 779. Oh, and that's the thing too. Your hands would be in if you were bid for the bid and out if for the offer or if you were selling. So the ARB clerks, they would just sit there all day and they would just like rotate their hands. Here's the 1, 2, 1, 2, 1, 2. Oh, 2, 4, 2, 4, 2, 4. So yeah, ARB clerk. And you might already have inferred this, but ARB comes from, conspicuously enough, arbitrage, which is like two simultaneous trades that leads to a riskless profit, which is not really the case of what an ARB clerk is doing, but that is where the term comes from.
It's also the sign language kind of became known as arbing, right? Even though it had nothing really to do with, there was no arbitrage going on when you were hand signaling all the time, but that's how it was you have to go learn your ARB to go learn all the hand signals, right? So even then it kind of struck me as odd. I was like, I'm not really arbing anything, but that's how it just became known. So yeah, the hand signaling was arbing, and then the clerk who did it was the ARB clerk, also known as the headset clerk sometimes, because you were on the headset usually back and forth between different venues. In my case, it was the SPX and the CME, but you could be on whatever equivalent pits floated your boat out there. Let's get in the weeds some more, Dan. Let's go out to another term that was kind of all the rage. You heard it a lot when it was first created. And it sounds wild, listeners, that the notion that it didn't exist all the time. What am I talking about? I'm talking about the NBBO, or the National Best Bid and Offer. Dan, when's the last time you heard someone say, I saw this on the NBBO?
Yeah.
You don't really hear that much anymore.
Yeah, you don't hear it too much anymore. I mean, it's fun. I mean, I mention it in some of our classes, but it's probably because I put it in a presentation a long time ago. I guess people really don't say it anymore.
No one has said. They did say that's the market, because that's pretty much what it is, listeners. That stands for the National Best Bid and Offer. And what is that? That really came about when multiple listings started happening, and instead of having each exchange having a proprietary market on each product, all of a sudden multiple exchanges were trading the same thing. And now all of a sudden you had places where one exchange was bid better than the other and vice versa, offered better, and you needed some way to track that. A broker would come into your pit. Let's say we were trading Intel on the CBOE, and maybe we were only $1 bid for an option. And he might say, hey, they're, $1.10 bid away or something like that. And we would be like, we don't see it. We're not making that good, So something that would track the best bid and the best offer on every venue. That's what was needed, and hence the NBBO was established. Looking at something, you're like, oh, where's that bid coming from? That's also why, Dan, it doesn't really matter for a lot of folks where they're executing these days. They don't care if it's the Philly that they're hitting that bid on, or if it's the Amex or whatever. They just want the best bid and the best offer. And that's what the NBBO shows you, sir. All right, Dan, hit us with another one, or should I keep going?
There could be a freaking show 3 on this.
There probably will be. So tell you what, we'll get to some mail call, and we'll save some of the rest for a future episode, Mr. Dan.
Mail call. Time to look at questions submitted by our listeners.
All right, welcome to the mail call, the portion of the show where we tackle your questions, your comments, your insights. We got some fun questions of the week going on right now, Dan. Let's pay off some of the ones that directly involved you from last week first, though. We had a couple that were inspired by this show, Dan. First off, we had that debate about back spread versus ratio spread, as you'll recall. Talk about another lost term. That actually was from the show last week. We were talking about lost terms. You fell down on the antiquated side of back spread. I said, no, ratio spread, far more popular. Our audience overwhelmingly agreed with me, Dan. 94.1% say they use ratio spread. Only a weirdo 5.9%. Dan and his monocle and his ticker tape and his cronies are the ones who say backspread, listeners. My goodness. So I'm glad to see our audience steadfastly supporting me, Dan, and effectively giving a giant middle finger to you. What do you say about that?
Well, I was definitely, I think both are a little antiquated. I think backspread is more antiquated. I do.
Oh, without a doubt. That's
for sure.
Again, another one that's kind of origins are somewhat lost to the mists and sands of time. And Dan, also on this show a few weeks ago, you and I were joking about trying to use your Bitcoin in the apocalypse. And that led to our question of the week last week, which is quite simply a little bit of a fun one. What is the best apocalypse asset? And we said, gold or precious metals or diamonds and precious stones. So your traditional hard assets, Dan, or the aforementioned Bitcoin, which has kind of kicked all this off, or maybe the ultimate hard asset, Dan, bullets. And 56.3% of our audience went with the ultimate hard asset of bullets, Dan. A third went for gold. Only 2.1% for diamonds or stones, which are kind of historically have been viewed as the portable wealth. You want to grab that if you want to get the heck out of Dodge in a conflict zone or something. And then Bitcoin came in third place, Dan, only 8.3%. Again, kind of hard to cash in your Bitcoin with the meat vendor in an apocalypse, Dan.
Yeah, I mean, especially considering not having electricity is one of the concerns in an apocalypse scenario. So, you could have your cold wallet, you could have your Coinbase, you could have whatever. It ain't going to do you any good. You can throw your cell phone at them. That's about all you can do. So, yeah, I'm clearly fading crypto in the apocalypse.
You got to have your solar powered crypto wallet. And then the vendor has to have his equally solar-powered point-of-sale system to cash in on your aforementioned solar-powered crypto wallet. And then there you go. Then you could buy all of your rotten post-apocalyptic meat with your Bitcoin, Mr. Dan. Our actual question of the week right now, Dan, is about what's going on in the Middle East and its impact on vol. We said, hey, the vol impact of the recent Middle East conflict already appears to be fading. This was on Monday. Obviously, a few more wrinkles since then. And we said, is this it, or is this just the calm before the storm? Quite simply, will this conflict still be impacting VIX and the markets 1 month from now? This has become a hotly contentious poll here, Mr. Dan. Which way do you fall, and which way do you think our audience is falling?
Well, 1 month from now is the tricky part of that, because I think there's a pretty darn reasonable chance that something, a severe escalation could happen. It's definitely not out of the realm of possibilities. I'm not predicting it or anything. I don't have inside information to the White House or something like that. But I mean, it's surely a possibility. But that being said, I mean, just you always look back in time and consider the fact that lessons get learned over time. Like when the war broke out in Ukraine, Jesus Louise, how long ago was that again? 2 years ago or something like that? The market sells off. And now all that stuff's still going on. I think to the same degree and sometimes worse, but the market just doesn't think about it anymore. So I don't know. I mean, if something happened tomorrow, like a direct armed conflict involving Iran and the US, no subterfuge, just truly, head to head, it would probably shoot the market down for a couple of weeks. But a month from now, I don't know. I mean, it might not be affecting VIX anymore. So I don't know. If you asked me that question a week from now, I'd have a more decisive answer.
That's cheating. You're a week in the future. You must give us your answer now, Dan. So are you yes or no? And which way do you think our audience is going?
I think it's not. Well, yeah, I think it probably will still affect it a little bit a month from now, just not as much as in the short term, presuming something happens.
Does our audience agree with you, sir? Or are they once again giving you the double bird?
No, they agree with me. They agree with me.
They slightly 55.3% say yes, it will be still impacting it a month from now. 44.7. It's been a hot one. It's been vacillating around 50-50 ever since we posted it, Dan. So our audience is kind of like you. They're having a hard time making up their mind. If past is prologue, the right play is to fade a lot of this Middle East vol because historically it hasn't really lasted very long. But you're right. If this thing blows up, pun intended, unfortunately, into something much more catastrophic, then perhaps maybe there will be, and certainly if it's still impacting markets a month from now, then it'll already have lasted longer from a vol perspective than 90% of the recent dust-ups we've seen. All right, Mr. Dan, that music means we have run out of time for unknown, forgotten terms. I guess we have to have an episode 3, Dan. What do you think?
Yeah, I mean, I'm looking at the list, and like every 5 minutes, I think of a new one.
There you go. We'll keep adding them, and I think the audience is loving them, so so we might have to have an episode 3. Listeners, submit your own forgotten, or let's say less heralded options terms that you think should be added to our list. Dan, we might have to become the repository of lost options terms here on the show. What do you think?
I think we could.
There's a lot of glossaries of options terms out there. Not a lot of glossaries of lost and forgotten options terms. That could be our niche. What do you think?
Yeah. Let's do it.
Well, if folks want to have their own suggestions for you, Dan, or check out what you got cooking, where should they go? What should they do?
Sure. Well, hey, I'll tell you what, because you're a podcast listener, if you still need a little bit more after this, I've got a little podcast project that's accompanying me writing my book, which is all on covered calls, cash secured puts. So just check out Wealth Building with Options on your favorite podcast platform, Wealth Building with Options.
There you go. So if you haven't had enough Dan in your life already, Wealth Building with Options, the place to go to get more. And speaking of getting more, you're going to get more if you're hanging out in the live. We'll be back in a few minutes with our good buddy Kevin Green to talk all things futures on the Futures Rundown. Let's light up the tape out there this week. Well, you got to tune in to find out. Of course, if you're one of our many on-demand listeners, check it out on podcast. Yet another reason why, if you're listening to OBC, you should be subscribed to our full network. A lot of great shows coming at you, including 2 new ones launched within the last year, the Futures Rundown and the European Market Brief. So a lot of great stuff coming to you, of course, if you want to hear it all live and get additional exclusive shows like our Pro Q&A with Scott Nations yesterday. Only place to get it, theoptionsinsider.com/pro is the place to go to learn more. That's going to do it for OBC. Back again in a few minutes with the Futures Rundown, and then back again next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.